ride. Good morning, everybody. Good morning and happy Monday, all you magnificent melon heads. A new week is upon us and all the hopes, dreams, possibilities that comes with it. Top story this week, not a lot happening in the States, but it's not the States you need to worry about. It's Asia, in particular, the world's second and third largest economies, China and Japan. That's where the focus needs to be, on the bond markets in China and Japan. Doesn't get all the headlines. I know, AI, Nvidia stock, S&P, the NASDAQ, right? They get all the headlines. The news happens in the bond markets. And the bond markets are worried about Asia right now. Let's talk about them both. China, the People's Bank of China, the Chinese state banks. Last night, they lowered their one-year loan prime rate. They were expecting a 15 basis point cut to that rate. It ended up being a 10 basis point cut to that rate. Now, keep in mind, we're talking about comparable to what the Fed had been doing last year. Remember, we had 75 basis point rate hikes last year. Well, China's going in the other direction. They're lowering their interest rates. They're trying to increase the borrowing in China. They're trying to get banks to start lending again. And so they're lowering interest rates to make it cheaper for people to borrow, to try to entice the banks to lend more, to try to get people to borrow more, to try to kickstart their struggling economy that's getting just absolutely killed by the collapse of the housing market. And if you saw my live stream for Friday afternoon, when I did the deep dive into what is causing the collapse of the Chinese housing market, you know that this is a futile gesture. 10 basis points is nothing in the wind compared to the tide that is receding from the Chinese housing collapse. Now, the point being here is that China's banks and the monetary policy support from central bankers and banks, it's not going to be there. You know, there's guys like Jim Cramer that says, oh, I know how they can fix the problem in China. They just stimmy, just print. Like that's their answer to everything. Central bankers will print. Problem solved, magic. Doesn't work that way for China. China's not the world reserve currency. They can't export their inflation. They're trying to be. Right? You've got Argentina is doing business in yuan, buying some of their exports. More countries are holding yuan than before, but still nowhere near the power that the U.S. has with that dollar reserve currency status. By the way, keep an eye this week, that BRICS meeting, the 22nd to the 24th. So I'm guessing if we do get an announcement of some kind of a new BRICS currency, it's going to be on Thursday. Don't hold your breath. Half the world's population is not going to be back on the gold standard on Thursday, like some people are trying to say on FinTwit and elsewhere on other channels. Hey, maybe they announce some new currency or some framework or a roadmap to a new currency or a plan or whatever soft language, but half of the world isn't going back on the gold standard this week. It's just not going to happen. So China does not have the central bank power to just wipe this out like the Fed does, which even the Fed doesn't have that power. They just make problems worse every time they do things like that. So they have to worry about their weakening currency. Right? If China wants to print money or lower interest rates to get out of this, they're going to weaken the yuan. And to an extent, that helps China because remember, it's the world's factory. You can weaken the yuan, and that makes Chinese exports more competitive. Right? As other countries take advantage of the Forex, Chinese exports become more competitive. The stuff made in other countries becomes more expensive, so it helps. But you can only do that so much. And I think we're already past the point where that helps China. Actually, we're getting into the point where that's starting to hurt China. Because remember, exports from China are way, way down. So even if this does help a little bit, you're talking about a diminishing return because the world is falling into a recession. The market for Chinese exports isn't there. So the weaker currency, there's fewer participants looking to take advantage of that because nobody can afford to buy anything because of inflation in the West. Now, China has the other problem of capital flight. As China weakens the yuan, as they lower interest rates, the reward for owning Chinese assets goes down because the currency that it's denominated in is getting weaker. And the interest rates being offered on the debt products in that country, like, say, developer bonds, which are trading at pennies on the dollar, well, if they keep lowering interest rates, those go down even more. The yield on them goes down. The return for holding them, the draw of those investment classes goes down. So China's worried about capital flight. If they ease, if they print, then anybody with any money in China is going to get the hell out of Dodge. And China needs to crack down on that. And I suspect that may have something to do with that big bust in Singapore that I covered on my channel last week. By the way, we've had more news on that. I'll be putting out a video on that probably later today, unless something big happens in the meantime. So China is in the corner here. The central bank, they can't just print their way out of this, not without putting more capital controls, not without slamming the exit shut all around the country and preventing their own citizens from taking their money and leaving. And the return, the benefits to their exports, not there in this economic environment. So China does not have a lot of policy options to solve this problem. And over at the Bank of Japan, it's kind of the other way around. The Bank of Japan is starting to slowly, very slowly tighten, exit their yield curve control policy, the most dovish central bank policy the world has ever seen. Japan is trying to exit from that policy, but the bond market has been instantly swallowing everything Japan will let them have. Every time Japan announces a small tweak to their policy and they say, we're going to let yields rise a little bit, slowly, boom, the market just takes it. Everybody dumps the JGBs and the yields instantly rise. And they rise so fast that it turns out that the central bank has to print yen and buy bonds to stop them from rising so fast. So as China, or as Japan, I keep getting them mixed up, I'm sorry. As Japan tries to back away from yield curve control, the bond market is chasing them more and more aggressively. They're trying to back away slowly, and it's resulting in them having to print even more to prevent those yields from rising too fast. And if you saw that interview I did with Michael Gayed from the Lead Lag Report, I did that 2 weeks ago, where we were talking about, hey, the yen carry trade, the ability to borrow cheap debt in Japan, convert to dollars, and buy U.S. stocks or U.S. bonds with that borrowed money. You make a lot of arbitrage. The return you get in those U.S. assets is more than you're paying in interest on that Japanese debt. And so that yen carry trade has been very profitable, and it's largely contributed to propping up the mother of all asset bubbles here in the United States. Well, as yields rise in Japan and as the pressure on the BOJ to let those interest rates rise continues, well, that yen carry trade is getting torn apart. And so sooner or later, that trade might unwind, which means people are going to be selling U.S. stocks, selling U.S. bonds, selling their dollars, converting them back to yen, and chasing the Japanese government bond yields. That would be catastrophic for Western assets. So as much as everybody just sort of, NVIDIA's up 2% today, yay, that's not what you should be watching. You got to be watching what central banks are doing in Asia. Watch that Chinese housing collapse and watch that Bank of Japan, because what happens there will dictate what happens to markets here in the West. And with that, let's shrink my big melon of a head. And while we're shrinking my melon of a head, won't you please inflate that like button? It really helps me with the YouTube algorithm. And if you're new to the channel, please stay a while. We do this every morning. And looking at the Fear Greed Index, we are not quite in fear territory. For a brief moment the other day, we were in fear territory on Friday. Right now, we're still in neutral on the brink of greed at just 45. The S&P 500 is looking to open up about 10 points this morning, up about 0.25% pre-market. We've got the Dow is essentially flat, up about 28 points pre-market. Not much happening in the Dow. And the NASDAQ is looking pretty good this morning, up 0.4% or almost 60 points higher in pre-market trading for NASDAQ futures. Looking over at the commodity boards, there's actually not a lot happening today, but a couple of commodities, the charts look interesting. Gold right now, December futures are up about $8 or 0.2% at 1,924. Silver's looking great this morning. September silver futures trading at 23.26. That's up 52 cents, a percent and a quarter for silver. Interesting things happening in the silver market, and WTI crude oil is up another 50 cents or 1.28% on the October futures, trading at 81.20. So first, let's look at the silver chart. Note this red line here. This is kind of this declining level of resistance that silver had run into a couple of times, really going all the way back to the silver squeeze in February, January of 2021. Every time we've come up to this resistance line, we have failed it. That was right up until March with the bank failures. And then you'll notice that line has been somewhat acting as support ever since. Now we're trading above it, bouncing off it every time. And I want to zoom in a little bit here on this silver chart, because we got a couple of things are happening right in this area here. All right, first of all, we bounced off of that descending level of what is now support again. We bounced off of it, and now we're coming up, and look, we're right at the 200-day moving average on silver. So we're kind of in between these two very powerful technical points here, the 200-day moving average to the upside, limiting you to the upside, and this declining level of support to the downside. Look for a break above or below this gap here to see which way silver wants to move. And you've also got a 50-day moving average that's starting to converge with your 200-day moving average. So that could be a significant technical event there. Either way, watch those two lines, that 200-day and this descending support line, which right now sits at around 22.42. Silver's kind of interesting here. Now, crude oil is also interesting. U.S. crude output to rise to a record 12.7 million barrels per day in 2023. This story is old. It's about 12 days old. But U.S. oil output is on the rise. And that's important because that's wrong. It's not to say it's wrong, but it's hiding a bigger problem. U.S. crude oil production is expected to rise 850,000 barrels per day to a record 12.76 million barrels per day in 2023. The last record output was 12.3 million barrels per day in 2019 before the COVID pandemic crushed demand and prices, and drillers were hit by higher costs that squeezed profit margins and investor demands to limit spending. So U.S. oil production is on the rise. We're approaching a record. Why does that worry me? Because of this chart, the Baker Hughes rig count, and more specifically, the one-year trend of the Baker Hughes rig count, because last Friday it dropped again by another 5 oil rigs. The number of oil rigs operating in the United States is in decline, and it continues to decline. It's been doing that since June. I've talked about it a lot on this channel. Every week, we lose another rig or another 5 rigs. All right, so we've got this record oil output because the number of rigs that are still operating are very productive, and they're getting more productive. But the number of rigs that are operating is in decline while that's happening. Now, right now, the increase in production per rig is offsetting the decline in rig count, but it will not always be that way. Soon, or someday soon, that's going to swap, where the increases in productivity are going to decline, and the rig count will continue declining, and U.S. oil output will start to fall. You got to watch that oil rig output. Without higher prices, new U.S. rigs will not come online, and U.S. production will start to fall. And this happens with a lag. It takes time to poke a hole in the ground and result in more oil coming out of it. It takes a couple of years. But this is a worrying trend for the long-term U.S. oil supply. And I also just want to mention we have something similar happening here in oil to the silver chart. We've got the 200-day moving average, and then we've got this red line. That's the previous high from back in April. And look what we got happening down here. There is a golden cross about to happen in oil prices. The 50-day moving average is about to cross above the 200-day. That's a major bullish technical indicator, but that's happening right as oil prices are having trouble retaking this resistance point, this prior high from back in April. Now, we've got a couple of things could happen here. The U.S. still has to refill the Strategic Petroleum Reserve. All right, that's a lot of pent-up oil demand that's still out there. You've got the odds of the Saudis could cut production again, or the Russians could cut production again, right? Every time oil prices have gotten into the low 70s or the high 60s, there's been another production cut. So there's downside limitations as far as oil supply goes. But at the same time, the collapse in the Chinese economy, that is some major demand destruction that's going on at the same time as these supply disruptions are happening. So my mind is still not made up where oil is going here. But the oil chart is interesting. You've got dwindling supply, but you've also got cuts in demand. It resembles the housing market in that regard. So keep your eye on oil. The U.S. dollar, meanwhile, is down 8 basis points this morning at 103.3. Slight downward move in the Dixie. The DXY came up, by the way, broke above the 200-day moving average a few days ago. This is going back to about May on this chart. We broke above the 200-day moving average, and it has been acting as support ever since. So we'll see if that one holds for today. And looking at the U.S. bond market, we got yields are, I clicked on the wrong thing. Give me back my bond markets. There we go. We got the 30-year Treasury yield is up 8.5 basis points this morning at 4.46. The 10-year is up 7 basis points, 4.32 on the U.S. 10-year Treasury. 2 years at 4.98 up. That's up almost 5 basis points. And even the 1 month is getting in on it today, up about 1 point or 5.39. Now, check out the long-term chart on the U.S. 10-year. We broke out above this prior high from back in November. Onward and upward, guys. 10-year yield is moving higher here. Long-term debt is getting more expensive. The U.S. government is issuing more long-duration treasuries, whereas for the last 2 or 3 months, they've really been issuing only the short-term stuff. Looks like they're finally starting to, what's the word I'm looking for? Capitulate and issue more long-term debt. That's going to drive these yields higher. And there's no money in reverse repos to bail out the long end of the yield curve, right? The reason why we didn't see short-term rates really spiking while Yellen was issuing all those treasuries is because money was coming out of reverse repo, out of money market accounts, and buying short duration T-bills. So that kind of offset that issuance of this short duration government treasuries. But money won't leave money market funds to buy 10 years or to buy 30 years or 20 years. That it doesn't work that way. So these yields are set to move higher if Janet Yellen is going to issue a lot of new U.S. treasuries with 10-year, 20-year, 30-year durations. Now let's talk about China, because this is a big one. And this to me just telegraphs weakness from the Chinese banks is what this does. China's central bank trims one-year rate, but unexpectedly leaves the 5-year rate unchanged. China's one-year loan prime rate, or LPR, the peg for most of household and corporate loans in China, was cut by 10 basis points from 3.55% to 3.45%. Tiny little rate cut here. Just shy of the 15 basis points that a majority of economists expected in a Reuters poll. China left its 5-year loan prime rate, or LPR, the peg for most mortgages, unchanged at 4.2%, while economists expected a 15 basis point cut. So the one rate that would have really affected mortgages, which is what China needs, they need people to borrow money to buy houses, even though nobody really needs houses because everybody already owns a house in China. A lot of people own 2 or 3. But they didn't lower the rate that would make mortgages cheaper. Again, this was not the move the market was hoping for. And I just want to give you a little bit of a summary here. The underwhelming LPR, or loan prime rate announcement, strengthens our view that the PBOC is unlikely to embrace the much larger cuts that would be required to revive credit demand. Remember, about a week ago, we talked about a story where new yuan loans were down 90% in just 1 month. Chinese banks are on defense. They're not making loans to each other. They're not making loans to people. And in a debt-fueled economy, if there's no loan growth, you're dying. You're dying slowly, and that's what's happening in China right now. Hopes for a stimulus-led turnaround in economic activity largely depend on the prospects of greater fiscal support, he added. So they're basically saying unless China is going to pass some new law, making the big investment in some other thing, unless it comes from the government directly, the banks alone are not going to be able to bail out this property bubble. And even then, I don't even think the government, I don't think there's any kind of fiscal stimulus that the Chinese can come up with. If they do, they're just going to add to their problem of capital flight. So China is kind of painted into a corner here. Let's moving on here a little bit. We have got the BOJ adjustments show strain as record bond buying continues. And this is the one you got to watch too because of the yen carry trade. The Bank of Japan is purchasing government bonds at a record pace this year, a factor that likely prompted its recent move to allow larger yield movements so as to reduce the strain on its control of longer-term interest rates. Doubling the effective cap on benchmark yields in December and again last month has yet to significantly reduce the BOJ's bond buying. That's the important thing, guys. They're supposed to be exiting yield curve control. They're starting to ease up, but as they've started to ease up and back away, they still have to buy the same amount of bonds to keep rates where they want them. They're fighting. It's a fighting retreat, if you will. The people selling bonds, the pressure on the bond market, those bond market vigilantes are not easing up as the Fed withdraws. They're having to fight every bit as hard to maintain those yields, even as they let those yields rise. The increase in buying after each policy tweak also raises the question of whether the BOJ moved too slowly in adjusting its settings, given how aggressively it's had to respond to stop investors pushing yields too far. That's the thing. If they're moving too slowly, everything the BOJ gives the market instantly takes. So they're saying the BOJ didn't move fast enough, but if the BOJ does move faster, the market is just going to instantly take it. And if the market instantly takes it, that's that yen carry trade starting to unwind. It could put downward pressure on U.S. asset prices. Data from Japan Securities Dealers Association on Monday showed that overseas investors led selling of 10-year Japanese government bonds in July, offloading 1.36 trillion yen, which was the most since January. If the BOJ decreases the amount it buys, market participants take that as a sign that it's close to exiting the policy, which boosts yields and forces it to increase the purchases. So basically, once people get a little sniff, a little whiff that the BOJ might be backing up, they instantly charge and they take that ground. And the Japanese government or the Japanese central bank then has to print more yen to push them back and hold them at bay. So there's no pressure easing up on the BOJ. The bond market wants to go higher, and the Bank of Japan is still having to print yen and still having to suppress those interest rates. And that's why this chart continues to move higher as they go. That's the wrong chart. Here we go. This chart. This is the Japanese yen against the dollar. As this chart goes higher, this is the yen weakening. And right now it takes 146 yen to make $1. That's up from just 129 back in March. So as the Japanese government withdraws and they start to let rates rise, they're having to print more and more yen to hold back the approaching tide of higher rates, even as they make this fighting retreat. Now, the reason that's important is because this red arrow right here from back in September, that was the last time the Japanese government started dumping U.S. treasuries and U.S. dollars in order to defend the value of the yen. And that was right here when we were at 144 yen to the dollar. We're higher than that now. So any day now, the Japanese government could start selling U.S. government treasuries and force U.S. interest rates even higher. So keep an eye on the Bank of Japan. It's coming. It's only a matter of time. And speaking of matter of time, the Stock Pulse Silver Symposium is in just 39 days. What are you guys waiting for? Get your tickets today at Caesars Palace in beautiful Las Vegas. I will be there. I'll be speaking on that Sunday. We've got the Ninjas going to be there, Joe Brown from Heresy Financial, Dan from I Allegedly. All your favorite financial YouTubers are going to be there. Come on out to Vegas. Let's hang out. Let's have a beer and let's talk finance. There is a link in the description below. If you use that affiliate link, you'll get 10% off your tickets, and I will see you in Vegas. And with that, I think we are going to wrap this one up, guys. I want to say thank you very much to everybody for your time this morning. Again, keep your eye on those Asian central banks. It's not about AI. It's not about NVIDIA. It's about what do those central banks do. Thank you, everybody, for watching today. Thank you very much to my Patreon supporters for everything you guys do for the channel. Also, hi, Mom. Hi, Dad. I love you guys. Till next time, live small and dream big.